Welcome to this video on discounted cash flow. Now this fits into my Valuing Companies series. So for those people who've not seen the introductory video, 3 ways to value a company, that could be useful background. Today I'm going to take on the third technique. All right, just to remind you, if you were looking at your property, for example, you could go bottom up and try and value it based on the cost of bricks and mortar. All right, that's called a net assets approach when applied to a company. That's not today's video. You could look at similar houses in the street, try and work out if yours is worth something similar. That would be a multiples-based approach using company jargon, and we're not covering that one here either. What we're going to do is look at a company a bit like a property from a point of view of how much money it will generate in the future. Some people value properties by saying, well, let's just look at the rental income we can squeeze out of this thing in the future, bring that together and come up with a number. Well, that in companies speak is called discounted cash flow. All right, and that's what we're going to focus on here. So, with no more ado, let's imagine, very simple scenario, a little bit of maths coming up. Let's imagine that we have a company with a 5-year life. Now you'll say straight away, that's artificial. Well, the whole of discounted cash flow involves making some quite big assumptions, and at the end, I'll explain which ones you need to do more work on in practice. Okay? So, how do you go about it? You would say, right, I reckon I can forecast the cash flows for this company over the next 5 years. All right? And imagine I've managed to do that. So I've managed to forecast, sales, costs, to get to some kind of profit, turn that into cash flow, and I'm comfortable that I can say over the next 5 years, so there's 1, 2, 3, 4, 5 years. Very simple example, the forecast cash flows are 100 million, 100 million. This is all in sterling, I won't keep writing the pound sign there, just get annoying after a while, 100 million and 100 million. All right, now it is a very simple example, just an introductory video. I can always do more later if there's demand. So far, so what? You might say, well, that's easy, Tim. Crikey, you didn't need to write that on the board. The company's going to generate 100 million for the next 5 years. It's only going to last 5 years, so it's worth, ta-da, 500 million. Not so fast, all right? Because straight away you've got a problem, which is, if you've got your forecasts right, let's assume you have, is 100 million in 5 years' time worth as much as it is received in 1 year's time? And the answer is no, because inflation erodes the value of money over time. Now, this is not a maths video, and I cover sort of discounting somewhere else, which I mentioned at the end, but what I'm about to say is you can't just add up these 100 millions and say, well, the company is worth 500 million. That's the value of the income it generates, because you need to do something called discounted, hence the expression DCF, discounted cash flow. So I want to make another assumption here, and you might be saying, how can you make all these assumptions? Well, in practice, this is exactly what people need to do who apply this technique. So here's my next assumption. I'm going to say that interest rates over the next 5 years will be 10%. Now, if you take an interest rate of 10%, what you're going to be doing is saying, well, based on that, 100 million received in a year's time is worth a little bit more than 100 million received in 2 years' time, which is worth a little bit more than 100 million received in 3 years' time, and so on and so forth. And the reason for that is that basically, if you've got 100 million in a year's time, you could be investing it, if you want to see it this way, to earn interest at 10%. So it's worth more to you than 100 million received in 4 or 5 years' time, because that can't be invested now to earn anything. All right? So money has a time value. The sooner you get it, the more it's worth, basically. So to cut to the chase, what you need to do is reduce these future 100 millions back to the equivalent of today's money. It's called discounting, okay? And for those people, the techies out there who want to know the little formula that you use to do this, and then I'll sort of cut in and give you the numbers, but the formula you use says what you should do is take each cash flow and apply a little formula that says, basically, you divide it by 1 plus r to the n. Now, this isn't a maths video, but r is the interest rate, n is the number of periods. So I'm going to divide the first year's cash flow, assuming it's received in 12 months' time, by 1 divided by 1.1. Then take the second one and divide it by 1.1 squared, 1.1 cubed, and so on. Okay? And if you do that, and this is just an introductory video, remember, just to show you the principles, if you like. If you do that, you find you need to reduce, rounding slightly, the first year's cash flow a little bit, because 100 million in a year's time isn't worth quite as much as if someone gave you 100 million pounds now if interest rate's 10%, because if you had it now, you can invest it and earn that 10%, okay? Then you need to reduce the second year's cash flow. I've rounded slightly by 0.83. You're wondering where these numbers come from. That's basically 1 over 1.1 squared, for the math mo's out there, okay? The next year's cash flow, again, not going to do more than 2 decimal places. You multiply by 0.75. The next year's cash flow by 0.68. And the next one by 0.62. Now, the effect of this is as follows. What you're effectively saying is that 100 million received 1 year from now isn't worth as much as 100 million. You'd rather have it now. It's actually only worth roughly 90, applying discounting principles. Equally, 100 million received in 2 years' time isn't as valuable as 100 million now if interest rate's 10%. It is, in theory, if interest rates are 0, but rarely are interest rates 0. They're close now, but they're not quite 0. Interest rate at 10% is quite high. I'll explain where I got that from in a moment, but it would reduce the second year's cash flow to more like 83. This is simply multiplying these out. 75, 68, and 62, all in millions, all in sterling, all right? And that means adding them all together, the, wait for the techie phrase here, net present value of those 5 years cash flows in today's money, if interest rates are 10%, is roughly 378 million, not 500 million, which is what you get if you just added them all together, okay? And the higher interest rates are, the lower the value of those cash flows, and the lower the value of the firm overall, okay? And where this is going is that, you know, if I was using this technique to value a company that could generate 100 million 5 years consecutively if interest rate's 10%, I get to 378 million, and then I'd be saying something like, well, there's the value of the company. If it's issued, say, 100 million shares, each one is worth about £3.78, okay? Now, very simple introduction. Some of you will be out there screaming into the ether, but Tim, you've made lots of assumptions here, there are things missing, okay? So I'm going to finish this video, and I'm very happy to carry this story on if there's demand for it, but I'm going to finish this video by saying, you know, what could possibly go wrong, okay? What haven't I considered? Where are the ambiguities, if you like? Okay, first of all, do companies stop after 5 years? Not usually. They keep going. Okay? How would I deal with that in practice? I'm not going to do it here. What I'd need to do is plug in what they call a terminal value and then discount that back and add it on the end. A terminal value would be me saying, you know what, after 5 years, there's no point in forecasting individual cash flows. I mean, it's bad enough forecasting for 5 years. You know, I'm not going to carry on forecasting something that might happen in 15 years' time. So I'm just going to say, I reckon the company will generate a certain lump of money for its remaining life, and I'll discount that back in one go. It's called a terminal value. Again, that's all I'm going to say about it in this video. So I've missed that out here. That's problem number one. Problem number two, how good are forecasts in the first place? Good question. Forecasting cash flows is hard, all right? And if you make a mistake in the early years, it radically changes the value you come out with down here. So that's problem number two. Okay, I didn't say DCF was easy or pinpoint accurate. Problem number three, screaming at you, I'd have thought, is where on earth did you come up with 10%? Why not 5? Why not 0? Why not 20? And the answer to that is people do scratch their heads long and hard about where to get that 10% from. The 10% reflects a number of things. The riskier you think this business is, the higher that number will be. The higher the value of other opportunities. So if you could put your money into a bank account that paid a decent interest rate, you'd want even more for investing in a risky company. That pushes the rate up potentially as well. Okay, liquidity, how easy is it going to be to get these cash flows out of the company? All these things affect that 10%. And there are various models which I won't go into today. One of them is called the capital asset pricing model that investors use to come up with a rate that reflects the risk potentially associated with these cash flows from this particular company. All right, so there you have it. Well, what do you have exactly? What you have is a technique that looks quite scientific, especially done in full, and gives you a number. Sounds good, 378 million, okay? But valuing companies isn't easy. There's no foolproof scientific method. It requires you to make quite a few assumptions. It requires you to do forecasting. It requires you to come up with the right interest rate. It requires you to add everything up correctly. But it is nonetheless recognised as one of the sort of front-running techniques used to value companies or even individual shares. Okay, so to sum up, when you're looking at different ways to value a company, it's pretty unusual at some point if you don't think about using discounted cash flow to generate one of the numbers that you need.